Hi, Ertan. Welcome to the Investor Talk. Thank you so much for coming.
Hey Max, thanks for inviting me.
Thanks to you. Thanks for your time. So, if you want to start giving a bit of background on yourself.
Sure. My name is Ertan Can. I'm based in Frankfurt, born here, raised here, and I'm the founder of Multiple Capital. Multiple is a fund of fund focused on micro VCs. I'm doing this now for almost a decade. Before founding Multiple, I was working for a German family office and did the same thing. So in the last 9 years, I've invested in 45 micro VCs in mostly Europe, but also in the US. And that's a very quick background. Before doing the fund of fund business, I did work in different financial institutions in Frankfurt. From JP Morgan Asset Management. To a SocGen group, to another fund of fund, but more in loss unlisted, in listed equity. And then finally, I worked for Thomson Reuters and covered investor relations departments. So did more like it's more like an enterprise sales role. And then before moving to venture, I did a very late MBA. And with that MBA, I just switched the roles and got different offers. And one of those offers was from a family office, and it was really jumping into cold water because I was not an investor before. And then the funny thing is, I was hired to invest in companies first. So I did like 20 plus direct investments in early stage companies. And then I realized, okay, I'm probably not the best, investor in tech companies. And I went back to the family and said, I don't think that makes sense. I don't think I'm the right person doing this. I don't think the portfolio will be good. And so I proposed them to do a fund of fund instead. And in 2013, that was like one of the first pan-European, private vehicles investing into what we call at that time, micro VCs or seed funds. And that was like the birth of my current business, right? So I really convinced them, they liked the ideas, and then I started looking at a lot of funds across all European countries, and did my first investments, and so that's the basis. And then
Thank you, Ertan. That's very interesting. You are the first fund of funds, so it would be very nice to go through this talk. I mean, investing in other funds, which kind of funds are they? VC, only VC, or where do they like invest in Europe, US?
yeah. So we are doing only venture, and within venture, we are doing only small funds that invest very early stage. So what we call, the first institutional round, the first round that a company takes. So we're not doing multi-stage funds. We're not doing larger fund sizes. We're not doing growth funds. We're not doing late stage funds. All those things. It's not our focus. Okay. So that is our niche. It's like very, very focused on these small funds. Many of them cover just a specific region. Let's say in the Nordics, it's a small fund covering one Nordic or several Nordic countries, or the Baltics, or Eastern Europe, or the DACH region, Germany's German-speaking region, or UKI. So, and the other focus that we have is investing into funds that have a vertical focus. Not a regional, but someone who's more focused on life science in Europe, or on crypto, blockchain, Web3 in Europe, or AI machine learning in Europe, or we have one fund that is focused on quantum technologies, right, across Europe. So these are the vertical funds that we do. So that's what we do. What we don't do is, we don't do any listed things. We don't do private equity. We don't do real estate. We don't do anything else. So we are only focused on small venture capital funds.
I mean, how big normally are these funds in terms of, and how much do you commit in them?
Yeah, the smallest funds are five-ish, and the largest funds are 100, I guess now. The sweet spot is between 10 and 50, and the average is around 30. So that's the fund size, and the trend is rather to smaller funds than to bigger funds. So I think the latest 10 funds were more like 20-ish, 50 to 20 million in fund size. We can do, as small as 5 million, and we could do more than like funds than bigger than 50 million, but typically we prefer to cap it at 50, right? So to cut it at 50. The probability for us looking at funds larger than 50 million just becomes very low. It has to be a very, very strong other reasons to invest in that fund. Sometimes we do, and we have, I think, in the 45 funds, 3 or 4 funds are larger than 50 million. But again, the majority, 90%, is smaller than 50 million.
Thank you. I mean, in terms of, you say the sites, how much are you going to cover in each of these or each of these funds? And when you set up, when a new fund start the setting up stage, you are the one who is going to be the anchor in this fund?
We are not a typical anchor investor. We're too small to be an anchor investor, to be honest. We do sometimes anchor together with other investors, like the first closing of small funds. So let's say I remember one fund where we anchored the fund with 3 investors, like so us and 2 more, and altogether we invested like 5 million, and that was the majority of the first close. But we alone do not typically anchor size-wise. Our average ticket is around 1 million, and with 1 million you can't even anchor a 10 million fund, right? So we're not aiming to be an anchor. We're also not aiming to have LPEC seats, board seats, advisory seats. We think we become very passive after investing. Our target is really to build the right portfolio construction and trust the people that we invest in. We do sometimes, I am in a few LPECs, but that's more funds that are very, very early and not experienced as a fund manager. So helping them in the first years to, get things done like reporting, how to communicate, how to raise their fund in the first 1-2 years, helping them on that. But other than that, we're not very actively involved in their investments.
I mean, being a fund of funds, you are in some kind not directly, indirectly connected to the startups where these funds invest. So how important is for you know exactly the logic behind each of these funds? Where do you invest? How much you invest? And what's going to be the way out in 5-10 years?
So for us, it's important to understand before we invest what we expect, right? And how they think and how they probably build their portfolio. And we try to do that to some extent as much as we can. And also sometimes, we're waiting for the final close to see if they're really doing what they have, what they promised or wanted to do, if they're getting into the right companies at the right stage, if they're focused on the seed stage, or if they're opportunistic. So this is something that we are trying to understand before we invest. When we do an investment, typically as a limited partner, as one of them, one of many limited partners, we are not looking too much into the portfolio anymore. We trust the GPs who are very much aligned with us, because we think that the carried interest is the biggest economic factor for those small fund GPs, and it's not the management fee. And that's why all of them have an interest to really build a very successful portfolio. And we trust on them. So we trust either when they are in the region, we trust that they are seeing the right companies, invest in the right companies, or within the vertical. And sometimes the verticals are so deep, like technologically deep, we don't even understand the companies that they are investing in, right? So I don't have a technical background. We don't have a technical background in the team. So when we invest into a, let's say the most technical fund is a quantum technologies focused fund. We don't understand. We're not, people who studied physics. We don't understand quantum technologies well enough. But we trust them. We think they are the specialists for this kind of investments. And that's the way how we, build the portfolio. And we are more focused on building a stable portfolio and construct a stable portfolio that makes sense from, more from a let's say asset management correlation point of view, than really looking into the single companies. And we're a strong believer in power law. So as long as you invest in a lot of like in a wide enough portfolio, we think it happens that some of the companies break out. And this happened in almost every vintage we invested in. And that helps in venture to create the kind of returns that you expect, right?
That's very interesting. As I'm setting up my VC after we ask you for advice and maybe some money. Let me ask you, it's very intriguing to me. You do not analyze in details each of them in terms of you are not getting yourself into management of these funds. But how exactly do you decide to commit your money into one of them based on the track record of the funders or the managers of the fund, or based on what they are going to do after? What is the logic behind? Because in any way, you need to decide, and you need to decide between probably many.
So the first hard factors are the things that I mentioned, like small funds, investing at seed stage, having a clear focus. So these are the simple selection criterias, right? So again, if someone pitches us a fund 100 million plus, it's a clear no, right? If someone wants to do late stage, it's a clear no. If someone wants to be a global generalist fund, it's a clear no, right? There's no niche, okay? So these are the like the hard selection criteria, and this is even not done by me, but by my team. They just select the funds out that are not a fit to our thesis. And then we reduce by that the deal flow. And then, of course, there's still a lot of funds. And then what we do is like what we call the qualitative part. We try to speak with them. We try to understand if they're, if they are fully aligned, if they are true hustlers, if they want to succeed. So then it's becoming very qualitative, the decision, the factors, right? So it's really, I don't know, meeting 10 funds in Spain and then selecting one that we think is probably the best out of them, right? So whatever the best is, right? So and most of the funds that we invest are emerging managers. There is no track record. You can't look at the last 10 years and say, oh, okay, he has invested in 50 companies and that's the track by vintage. That's not really happening a lot in Europe so far. You don't have a lot of emerging managers with a huge track record. So we are not investing based on track. Okay, that's not a typical way we are selecting funds. It's more, you can say maybe investing based on, do we trust this person or the team to build a great track in the next 3 years? Okay, and that is something you can't. There's no quantitative method to track that and to understand that who is the right person to do that. There's some kind of risk involved, of course. You might be on the wrong side.
I mean, venture capital is pretty young in Europe. If we compare ourselves with US, we are probably 10 years at least behind. But it's very trendy. It's building up so much. I mean, I think 2021 has been committed over 100 billion. So it's start to be a third of America, but we are catching up a little bit. But as you are early, what about accelerators, incubators, laboratories, which are very trendy now? There's so many.
We don't invest in accelerators. Okay. We never invested in an incubator as well. So we are not actively looking at accelerators and incubators. We don't think we've met any really interesting accelerator or incubator. I have the feeling that most accelerators and incubators have, the people that we meet are like preparing their own fund in the future and using the accelerator to see and learn and work like an employee. I've never seen a lot of accelerators really having, real like ownership carry and a setup that is a high incentive and high alignment over a long-term period. It's different in the US. You have the kind of, the YCs, and not many other, by the way. So there are not a lot of accelerators where you would where I would, but again, I'm not looking at a lot of accelerators. So there's a new trend called studios, right?
Yeah.
Where you know, um, where you start the companies in your studio and get an equity share of 20 to 50%, like a co-founder. Again, I think, of course, if you have the right companies or one right company in that kind of studio model, you can you have a much bigger share in that company, and that can lead to huge returns. But in general, I think if a founder can raise capital without giving away 50% of his shares, he would. Right? If I'm a founder, I would rather take a seed round and give away 10% or 15% of my shares than going into a studio and give up 25 to 50% of my shares. So it's, in a way, I think there is a potential of negative selection, adverse selection, because the best founders might not use the route to go through a studio.
Yeah.
But of course, if you're lucky and you have the right companies in the studio, you have a huge outcome because you have a lot of ownership in those companies. We have not done any studio. So what we have done to answer this, what we have done, I think once now or twice, is some of the accelerators set up a seed fund.
Yeah.
It's more like an opportunity fund, okay? But still, because the companies are so early in the accelerator, the opportunities are at seed stage, okay? So it's more like looking at your own portfolio that you have in your accelerator, and if it's a broad accelerator, it might be 200, 300 companies, and then selecting the 10% of those companies that make most sense and still invest at seed stage, okay? That is something that we've done. That is something, it's a no-brainer for us. It's accelerator work is quite, it's good on average, and you see a lot of companies and you see the founders early on. You can cherry pick. You have an access to companies that you know already who might be, breaking out of your portfolio.
Yeah, and somehow makes sense. Already then, maybe the best performance, and you can move them up investing.
Exactly.
I
There, the
mean,
problem is, do you really still have access, right? So let's say if you have not done a good accelerator job, why would the founder take your money as a seed investor?
of
Okay.
course.
So here, you really have to still get access, but if you're not the lead investor but a co-investor, it still can make sense to try that model out.
I mean, also when it comes to accelerators, you need to be you have to see how really active you are, because I've been talking to many. Some of them, they say they're active, but they're not active. I'm sorry.
Yeah.
So it depends how do you describe you be active. Okay, if you really help these guys, or maybe you have 1 meeting per week, 1 meeting per week probably is not going to be enough.
Yeah.
But what about evergreen?
Yeah.
Do you invest only in closed funds, having 10 years life, or even open-ended funds, evergreen funds?
We don't do open-ended funds. So we don't do evergreen funds because we are not an evergreen fund ourselves. To be honest, it's a new trend. And I think some players can use that structure because they don't have to raise again and again, right? So they could raise once and keep those LPs because there's so much. Let's say, Sequoia. If Sequoia is raising an evergreen fund,
Yeah.
the LPs would be fine to be evergreen in that, like at least for the next 30 years, without doing a structure again and again, just being committed into that 30-year evergreen fund. If you can allow, if you have the brand to do so, and if you have the LPs who trust you to, for a long period. What we try to avoid is timing. Okay, so we are not good in timing. We don't want to time markets. What does that mean? we wouldn't know when to exit the evergreen fund, right? And how to exit the evergreen fund. So what we trust on is the lifetime of these kind of funds that we invest in, like our lifetime. But what we trust in is that people invest in 3 years, and then they build the companies, and then those companies are sold latest in 10 to 12 years in a fund life, right? So, and some are sold in year 5, and some in year 8, and some in year 12. But then this fund is over. There is no timing. There is no decision by the fund manager to sell at some point all the portfolio or some of the portfolio. We, I'm not as smart, I guess, but I don't understand how that should or could work in venture. If you want to, if you have to exit at some point, if you have to distribute, um, yeah, and look, I'm not automatically re-upping in most of the funds that I'm investing. Means that I might, trust you for the next 3 years, but you might change your strategy in 3 years' time, and you might do different investments in year 4 or 5, etc. So if it's an evergreen structure, are we still investing? Are we still, part of that story that we don't like to? Can we exit? How do we exit? So many questions. I think for us, we try to keep it. We are a small structure. We try to keep it plain and simple and very lean. And the way how we work at the moment is with closed-end structures. So our fund is a closed-end structure, and the funds that we invest in are also closed-end structures. And we invest typically in two to three vintages per fund with each of our funds.
I mean, what's the expectations, the return you expected for your funds on average?
Yeah. So the answer to that is the expectation is it's relative. Okay. So what we try to do is to build a portfolio that on average will return between top quartile and top decile. Okay. And whatever top quartile is in the next 10 years, that is our target, right? In the last 10 years, you could say, the top quartile returns are maybe 2.5x or something like that. So if we meet the 2.5x, that will be great. That will be a great return. Now we have done a much better result in the last 10 years. So than the 2.5x. So I would say we are more like top decile, or even, within top decile, a very good result as a fund of fund compared to VC. So that's great, but our long-term result is to deliver investors long-term top quartile results in venture. And if you achieve top quartile results after fees with a fund of fund, we think that this is a great result long-term, right? So whatever top quartile is, again, right? So it might be that in the next decade, top quartile is 1.8x, right? Or 2.3x or 3.3x, I don't know, right? But whatever it is, we want to achieve that result because we think that we can select the better funds out of the universe, and those better funds on average, not all of them, but on average, will return what others consider top quartile.
I mean, in terms of funds, there are so many different venture capital funds. Some of them more agnostic, let's say. Some of them more opportunistic. Some of them very, very going precisely. I'm only investing in deep tech. In deep tech, I'm going even more vertical. In your experience, which are the most performing?
So okay. Historically, in our opinion, the best performing in our portfolio were the generalist funds. Okay, generalist funds focused on specific regions. We call them local winners. Okay, so a fund mostly in a region that was not very active. Let's say a fund investing into Eastern Europe, right, in the last decade. So when Eastern Europe was not like a place where a lot of people raised capital, right, or a lot of funds were active, those funds could cherry pick in the region, right, and invest in companies that no one else really saw early on. That's the kind of those are the strongest funds in our current portfolio historically. For the future, we think that potentially some of the vertically focused funds, the specialized funds with operational backgrounds might be the best funds performing. But we don't know. I can't say what will happen in the future. I don't have a crystal ball. That's just my expectation. Some of the vertically focused funds might outperform the generalist funds, because as a generalist fund, it is more difficult today than 5 to 10 years ago.
What about these new funds? I was talking with the Phoenix founder 2 days ago in London, and crypto, blockchain, metaverse. So we are going to a completely different economy. What's your point of view on if someone was setting up today a fund in crypto or blockchain, metaverse? So we have NFT. Would you commit your money?
Yes, yeah, it's one of the verticals that we definitely think makes sense. So we ourselves are relatively agnostic, right? So we don't have a clear opinion on which vertical is, which vertical we should invest in. But I think we have, when you look at crypto and blockchain, we have like 20% allocation on crypto and blockchain. Okay. So from all of the funds that we've done, I would say like 6 or 7 funds have a crypto blockchain um, um, angle. But we have also invested in other verticals, like for example, life science. We have at least 2 or 3 life science focused funds, right? So again, are we life science specialists? No, we're not. Do we think that life science will be the best performing asset class? We don't know. Same for crypto. We don't know, but we want to have them in our portfolio, especially if the managers are what we call the best managers, right? So the best that we see. So just to give you an example, let's say, I don't know, a very rare thing that we have seen was like an ocean tech fund, okay, or space tech. There are a few space tech funds. We've never invested into a space tech fund. But if we would see a great manager that convinces us, look, Ertan, that is my background, and that's why I believe space tech will be a big thing in the next 10 years. Even though we are not understanding space tech at all, we might still invest and add them to the portfolio to diversify. Okay, so that's our opinion. And in general, we're playing a diversification game. So we have, like, in most verticals, I think we have some bets, including of course crypto, Web3, and blockchain, but also life science, synthetic biology, but also climate, clean tech, hard tech, deep tech, quantum. So I would say it is relatively broad what we do. We don't have I think what we don't have a lot in our current portfolio is like the typical consumer products.
Yeah.
So we think that quick commerce consumer is not really what we call venture. Venture should be what we call very capital efficient models.
Yeah.
And quick commerce and some consumer products are not really capital efficient. So if you raise $500 million to create $1 billion company, it's not very efficient for the investors, right? But if you raise 20 million to create $1 billion company, it's a super efficient, ROI on your capital, and that is something that we call, or that we think is more venture, or is real venture. Whereas the quick commerce consumer plays sometimes, even though they are huge, right? Some of them are becoming very quickly unicorns. But again, what's the valuation that you paid money in? What's the multiple on your invested capital? And the multiples are not high, even though they are unicorns.
I mean, I'm curious because I really want to understand myself also. Because I've been talking so much, and myself, I'm involved so much in venture capital, but never in funds of funds. Now, the basics behind a venture capital fund is I have 1 billion fund, and any company I'm going to invest into should pay at least out the 1 billion. Okay, so I'm done. I'm not going to lose money. I can pay money back to my LP. Okay, nobody's gained, but nobody lost anything except us. But maybe we got some management fee.
Mm-hmm.
What about the fund of funds? The logic behind is may commit my money in one fund, they pay off all the sides of my fund of funds.
You mean if one fund can pay back all the fund investments?
All the size of your fund, yeah. Let's say you have 100 million fund, okay?
Yes.
You invest in 10 or 10 million each funds. Should one of them give you the total return the equal the size of your fund, so you are not going to waste money? Because
Yeah.
maybe some of them they can bust.
Yes, sure. So the real answer here is,
Understand the logic if
yeah,
you can share, of course, otherwise not.
um, I can, yeah, I can give you a rough understanding.
Thank you.
So I mentioned, I think before, so we are strong believers in power law. Okay, so that means very few companies, so very few funds, but the real answer is very few companies will return most of the return. Okay, so we have a portfolio of now 900 companies. And in the first portfolio, we had 330, and in the current portfolio, we have something like 600. Okay. In the first portfolio of 330 companies, one single company is returning more than the total portfolio. So we could write off 329 companies.
Yeah.
We would still make a return.
Yeah.
Okay. So that's what I mean by power law. I think if you hit one of those, potential decacorns, then the rest of your portfolio becomes almost irrelevant,
Yeah.
right? And we are going, let's say, in a realistic way, we think like 10% of our companies are the real winners, outliers, right? So 10% of the companies means, if you have 330 companies, it's around 30 companies that are really exitable with a high multiple. Okay. Some of them are ultra high multiple, but many of them are high enough multiple to return really good amounts. And that adds up to what I said, adds up to a realistic, low risk, top quartile return.
Let me close with this one. You're very well positioned to have your point of view here because you've been investing in so many funds. Where do you see the venture capital in Europe going?
That's a difficult question.
Yeah,
I think there's still a lot of government money in the European ecosystem. I would hope myself that the government money at some point um, will make themselves obsolete, right? So, and we have enough private money means that the private institutional money is starting to deploy and allocate into venture. So the pension funds, insurances, big family offices, endowments in Europe have a real venture allocation, a long-term allocation. So we don't need most of the public government-driven players anymore. I think if you look at other markets, like the US, for example, you don't have that anymore, right? So you don't need government money
of
and
course not.
government backup to create a great ecosystem and a great asset class. And I think Europe is close to something that I call a tipping point, right? Where companies really are created that are super successful globally, and investors outside of Europe understand that and put money more and more into the European ecosystem. So I think today you have probably more money invested from the US and Europe compared to European venture capitalists, right? So, and even LPs outside of Europe are trusting more to the European ecosystem and investing more into the European ecosystem than private LPs in Europe. I'm not talking about the government LPs in Europe, right? So my personal view is that this hopefully will change in the next 10 years because of the results. So many of those private and institutional investors just waited for results for a long time. Now Europe just has those results and is on par with US results. So there is no reason anymore not to invest in venture. Okay, that is something that I see. And other than that, so midterm, I think that Europe, as well as the US, has a lot of dry powder in the next 5 years. I would say, right? A lot of funds have raised a lot of capital. So this capital has to be deployed. So for founders in the next 3 to 5 years, as well as early investors in the next 3 to 5 years, I think it's a very good time because you have a lot of follow-on capital that has to be deployed into the European ecosystem or even globally. So that's something that I see midterm. Long term, I think extremely long term. So I think I'm now a decade in this business. I would like to stay at least another 2 decades in this business. And so my long-term view is 3 decades, right? So delivering results over 3 decades and ideally every vintage. And that's what I also meant by I don't want to time markets, right? So I don't want to do timing within the asset class and allocations in the asset class. I think if someone does the work to select and diversify in venture over 3 decades, it will be one of the best performing asset classes. It was, if you look at the 3 decades and the past 3 decades, if you would have been allocating 3 decades long, it will be a great return. And I think this will be probably even better in the next 3 decades in venture.
Ertan, thank you so much for coming to the Investor Talk. It's been a very great pleasure for me.
Thank you very much for the invite. It was great to be part of it.